September 1929. A businessman in Manhattan sensed something was wrong, though he couldn't quite name it. Stock prices had been climbing for years, but underneath all that prosperity, cracks were forming. On a Tuesday morning, acting on instinct and a growing sense of dread, he walked into his bank, presented his passbook, and withdrew every dollar he owned in cash, $12,000 in bills, tucked into his briefcase. By Thursday, just 2 days later, the markets had collapsed with violence that would echo for generations. Banks across the country were failing as panicked depositors lined up outside locked doors. But he was safe because he had his money, and he could survive the storm. Now imagine trying that today. You sense danger in 2026 and attempt to do what he did. Withdraw your wealth and get to safety before the crowd realizes what's happening. You log into your 401k account and see $180,000 saved over 20 years. You click withdraw, but a penalty calculator appears instead. Federal tax, state tax, and the 10% early withdrawal penalty for touching your money before age 59 and a half. Your $180,000 becomes $98,000 before you see a cent. But here's what makes it worse. The withdrawal doesn't execute immediately. It enters a processing queue taking 7 to 10 business days under normal conditions. During financial panic when everyone's trying to exit, those systems can freeze entirely, not because your bank is failing, but because modern finance was designed to prevent exactly what the 1929 businessman did: escape. This is the difference between 1929 and 2026 that nobody's discussing. It's not just that another crash is coming, it's that when it arrives, you won't be able to do what previous generations could: grab your money and run. Your wealth is trapped inside systems with time locks, penalty gates, and legal restrictions that slam shut when everyone tries to leave at once. Every mechanism trapping your savings was built deliberately, not to protect you, but to protect the system from you making the rational decision to save yourself when disaster approaches. The 1929 crash was devastating because of speculation, leverage, and debt. The 2026 crash will be catastrophic for a different reason: digital cages that prevent escape even for those who see danger coming. Let me show you how we got here, why the traps are tighter than ever, and why 2026 makes 1929 look like a rehearsal. The 1929 crash destroyed millions of lives, but had one feature that today's system eliminated: immediate access to your money. Understanding this is crucial to seeing what we've lost. In 1929, your savings account worked simply. You walked into your bank, presented your passbook, a small ledger with handwritten entries, and requested your balance. The teller counted cash from the drawer. Same-day withdrawals of your entire balance were standard. No processing periods, no approval workflows, no suspicious activity reviews. If you wanted your money, it was yours within the hour. Stock ownership was equally direct. When you bought shares, you received physical stock certificates, ornate paper documents with your name and share count. These weren't digital entries in a database. They were property you held. To sell, you could find a buyer directly, hand over the certificate, and receive payment, or sell through a broker with settlement in 3 days, not 3 weeks, and not subject to trading halts. 3 days, predictably. This meant investors who sensed trouble in September 1929 had options. They could liquidate positions, withdraw from banks, and convert everything to cash or gold. Many tried. The problem wasn't that the system prevented escape. The problem was most people didn't see it coming until too late. When the crash hit October 24th, 1929, those positioned in cash and gold survived. Those who hesitated, who believed the reassurances, who waited one more day, were destroyed. But destruction came from their decisions, not from the system physically preventing action. Banks that failed didn't freeze accounts beforehand. They didn't impose withdrawal limits or require supervisor approval for large requests. They ran out of money because too many people withdrew too fast. That's a bank failure, and it's brutal, but it's different from what we have now. Even margin calls were straightforward. You'd borrowed money to buy stocks, putting down 10% and borrowing 90%. When stocks fell, brokers demanded more cash. If you couldn't provide it, they sold your stocks immediately to repay themselves. Harsh, instant, transparent. You knew exactly where you stood. Compare that to today's retirement accounts, where money is locked behind penalty walls until 59 and a half. Compare it to banks that can freeze accounts for suspicious activity if you withdraw too much too fast. Compare it to investment funds that can legally suspend redemptions during market stress. The 1929 generation faced a devastating crash, but they weren't facing a system designed to trap them. We are. After 1929, Regulators didn't just try to prevent another crash, they built something more ambitious, a financial system that could prevent people from escaping during a crash. Every major reform between 1933 and 2010 had the same goal: eliminate ordinary people's ability to trigger bank runs and market panics by withdrawing their money. The first cage was the 401k, created in 1978 and sold as a tax advantage. But look at what it created: $7 trillion in American retirement savings locked behind penalty walls. You contribute throughout your working life, but cannot access it without paying combined penalties and taxes that typically consume 35 to 45% of your withdrawal. But penalties are just the first lock. The second is time. When you request a 401k withdrawal, you don't get money instantly. Plan administrators process requests, taking 7 to 10 business days under normal conditions. During market stress, when everyone's withdrawing simultaneously, timelines extend indefinitely. Some providers can legally suspend withdrawals entirely for administrative review or plan valuation uncertainty. This happened during 2008. Fidelity, one of the largest 401k administrators, suspended certain withdrawal requests for weeks. Participants logged in to find temporarily unavailable messages. Their money was there on screen, but they couldn't access it. Not because they lacked funds, but because the system includes gates that close during volatility. Then there's banking itself, which has quietly restricted cash access for years. Try withdrawing $10,000 or more in cash. Federal law requires banks to file a currency transaction report with FinCEN. Banks also have discretion to delay withdrawals for suspicious activity review if they determine your request is unusual. Daily ATM limits typically cap at $500 to $1,000, meaning even with $50,000 in your checking account, physically accessing it would require 50 to 100 separate transactions over weeks or months. The crisis would be over before you could extract your own funds. But the most insidious trap is in investment accounts, mutual funds, ETFs, and brokerage holdings. Most investors don't realize their ability to sell depends on market makers maintaining liquidity, and that liquidity vanishes when you need it most. During March 2020, over 200 exchange-traded funds traded at 10 to 20% discounts to their underlying holdings. Your $100,000 ETF was only sellable for $80,000 to $90,000, not because assets had fallen that much, but because market structure broke down. Mutual funds have more explicit traps. SEC Rule 22-EE-4 allows funds to maintain up to 15% holdings in illiquid assets. When those thresholds are breached, funds can suspend redemptions entirely. This isn't theoretical. The Woodford Equity Income Fund in the UK suspended redemptions in June 2019, trapping £3.7 billion for over 3 years. When redemptions resumed, investors received roughly 70 cents on the dollar. Real estate investment trusts did the same during 2008 to 2009, suspending redemptions for an average of 18 months. Private equity funds have standard 7-year lockup periods with 0 early withdrawal options. Every one of these restrictions was sold as protecting investors or maintaining market stability, but the effect is identical. Your money is no longer accessible on demand. It's accessible on the system's terms, according to conditions that can change during crises. The 1929 investor could grab cash and run. The 2026 investor will click withdraw, see a loading screen, and discover the request is pending, subject to delays or suspension if conditions deteriorate. By the time access is granted, the wealth they were protecting will have evaporated. These mechanisms exist right now, embedded in every retirement account, every bank account, every brokerage and fund. They're waiting for the moment everyone tries to use the exit simultaneously. The traps have always existed, but 2026 is when they become catastrophic. Not because mechanisms changed, but because of what's underneath: unprecedented debt, algorithmic trading, and a Federal Reserve that's already fired its bullets. Start with leverage. In 1929, investors could buy stocks with 10% down, borrowing 90 on margin. That 10-to-1 leverage turned a 10% market decline into total wipeout. Regulators raised margin requirements to 50% after the crash, thinking they'd solved it. But today's leverage doesn't live in visible margin accounts. It lives in derivatives, collateralized loan obligations, and private equity structures, creating 20 to 50 to 1 leverage hidden from view. When that unwinds, it won't happen over months like 1929. It'll happen in hours as computers execute pre-programmed selling strategies. Unlike 1929, when selling meant humans shouting orders on a trading floor, Today, 70% of volume comes from algorithms executing millions of trades per second. These algorithms sell when volatility exceeds thresholds, when momentum breaks levels, when correlations indicate stress. When one starts selling, it triggers others, creating cascades moving faster than humans can react. We saw a preview in March 2020. The S&P 500 dropped 34% in 23 days, the fastest bear market ever. Trading halted multiple times by circuit breakers designed to let cooler heads prevail. But those halts didn't stop selling. They compressed it into smaller windows, creating more violent moves when trading resumed. Now, imagine that with all the traps I described fully engaged. You watch your 401k drop 30% in 2 weeks. You submit a withdrawal request, willing to pay the 40% penalty. The request sits in processing while the market drops another 20%. By the time it's approved, you've lost 50%, then pay 40% of what's left in penalties. Your $200,000 retirement account yields $60,000. That assumes the withdrawal gets approved. During peak crisis, administrators can invoke extraordinary circumstances clauses suspending all distributions. You're watching the number shrink, unable to act, trapped by systems designed for this purpose. Banking is equally fragile. In 1929, bank failures happened because banks couldn't get money back fast enough when depositors demanded cash. Today, banks hold more reserves and face stricter requirements. But those reserves are useless if payment systems freeze. Modern banking runs on digital infrastructure, Fedwire for large transfers, ACH for routine payments, SWIFT for international movement. Each system has quotas and can be overwhelmed during stress. In September 2019, during economic expansion with no crisis, the overnight repo market spiked from 2 to 10% in a single day. The Fed had to inject $75 billion to prevent seizure. That was during calm. When real panic hits, those systems stop. Silicon Valley Bank collapsed in March 2023 in 36 hours. Customers learned Thursday afternoon the bank was troubled. By Friday evening, regulators seized it. Depositors with more than $250,000 had no access until the following Tuesday, when the FDIC created a bridge bank, 4 days without money. For businesses with payroll due and vendors to pay, that 4-day freeze was existential. Now multiply that across the system during a real crash. Not one regional bank, but dozens. Not a few billion in deposits, but trillions. The mechanics don't scale. The FDIC has roughly $125 billion in its insurance fund to cover $10.5 trillion in deposits. The math doesn't work if even 5% of banks fail simultaneously. This is why 2026 is worse than 1929. The speed is faster thanks to algorithms. The leverage underneath is bigger thanks to derivatives. The tools to fight it are exhausted. Interest rates already at 5%, leaving little room to cut. Fed balance sheet already bloated from quantitative easing. Government debt at $35 trillion, leaving no room for massive stimulus. And unlike 1929, when people could try to save themselves by withdrawing cash and buying gold, the modern system has closed those exits. Digital gates, penalty walls, processing delays, legal restrictions, all designed to keep your money trapped when you need it out most. The 1929 crash took 4 years to hit bottom because people could withdraw and wait out the storm. The 2026 crash will be faster and deeper, precisely because they can't. The crash hasn't hit yet, but if you know where to look, the early moves are visible, not in headlines but in quiet actions of people with the most to lose. Corporate insiders, sovereign wealth funds, institutional investors with access to information you'll never see. In the fourth quarter of 2024, corporate executives sold stock in their own companies at levels not seen since 2021. Insider selling hit $16.2 billion in 3 months. Executives exercising options and dumping shares at 4 times the normal rate. These aren't retail investors panicking. These are CEOs, CFOs, and board members who see quarterly numbers before they're announced, who attend strategy meetings where real problems are discussed. When insiders sell, they're not timing a 10% correction. They're getting liquid before something bigger breaks. Sovereign wealth funds are making similar moves. Data from the third quarter and the fourth quarter of 2024 shows significant shifts away from U.S. equities toward gold, commodities, and short-duration bonds. Norway's government pension fund reduced equity allocation by 18% in 2024. Abu Dhabi Investment Authority increased gold holdings to levels not seen since 2008. These aren't institutions that panic. They manage trillions across decades, focused on long-term stability. When they reposition this defensively, it's because their models show risks that justify sacrificing upside to protect capital. Then there's the Treasury market, the $27 trillion foundation of global finance. In October 2024, liquidity started deteriorating in ways mirroring pre-crisis conditions. The bid-ask spread widened significantly. Large orders that used to move the market by a few basis points started creating 15 to 20 basis point swings. This is the illiquidity that precedes breakdowns. It means there aren't enough market makers willing to take the other side of trades. People are getting nervous about holding even treasuries, the supposed safest asset in the world. And while all this happens, media and Wall Street cheerleaders keep repeating the same lines used in 1929. The economy is strong, corporate earnings are solid, valuations are justified by innovation. This time is different. It's never different. The Shiller P/E ratio stands at 39 as of October 2025. It was 32 before the 1929 crash and 32 before the dot-com bubble burst. It's now 23% higher than both those peaks. But apparently artificial intelligence justifies valuations previous generations would have recognized as insane. The yield curve has been inverted since July 2022, now over 3 years. Every recession in the past 70 years was preceded by yield curve inversion, typically 12 to 18 months before downturn. We're now 39 months into inversion, well past normal lag time. Here's what makes this moment uniquely dangerous. All these warning signs are flashing, while the trap architecture I described is fully operational. When 1929 came, people had escape routes even if most didn't use them. Today, people who see what's coming, insiders, sovereign funds, institutions, are quietly repositioning. But the ordinary investor with a 401k and savings has no idea. They're being told to stay the course, keep contributing, ignore short-term noise. They're being positioned as exit liquidity, the last buyers before the trap snaps shut. History doesn't repeat with perfect precision, but it follows patterns anyone can see if they're willing to look. The 1929 crash wasn't random chaos. It was the mathematical result of too much debt, too much speculation, and people convincing themselves old rules no longer applied. The 2026 crash will follow the same pattern with one crucial difference. When it hits, you won't be able to do what 1929 survivors did. You won't walk into your bank and withdraw life savings the same afternoon. You won't sell investments without crushing penalties, processing delays, or potential suspension. You won't have freedom to protect yourself because the system was designed to prevent mass exit. Remember that businessman in September 1929? He survived because he acted before the crowd realized danger was real. He didn't need permission. He didn't need to wait for processing periods or pay penalty fees or hope systems wouldn't freeze. He saw the risk, took his money, and got to safety. You don't have that option anymore. The exits that saved him have been sealed, but you still have choices. You can acknowledge the traps and work within constraints. You can reduce exposure to penalty-locked accounts by redirecting new contributions to accessible savings, even though it costs tax advantages. You can build cash reserves outside the retirement system, accepting the tax burden now instead of risking total loss later. You can pay attention to what insiders are doing with their own money. When smart money sells while recommending you buy, it's worth asking why. Or you can do what the majority will do. Trust the system, believe the reassurances, keep contributing to accounts you can't access in crisis, and assume this time really is different. That algorithms and AI have eliminated the business cycle. That central banks can prevent any real pain. That markets only go up if you hold long enough. Every generation thinks they've evolved beyond history's lessons. The 1920s generation thought industrial technology created permanent prosperity. The 1990s generation thought the internet eliminated old economic models. The 2020s generation thinks artificial intelligence has conquered risk. They're all the same thought, wearing different clothes. People who survive crashes aren't the smartest or most connected. They're the ones who recognized the pattern before everyone else, who were willing to look paranoid while others celebrated, who understood that protecting capital matters more than chasing the last 20% of an overextended bubble. The traps are set. The warning signs are flashing brighter than they've been in decades. Insiders are quietly heading for exits while telling you on television to stay invested. The question isn't whether the crash is coming. The question is whether you'll be trying to escape through exits that no longer exist, trapped behind digital gates while your wealth evaporates, or whether you'll have positioned yourself outside the cage before it locks. Your grandfather in 1929 could grab his money and run. You can't, not anymore. But you can still prepare for what's coming if you act before the crowd realizes danger is real. Because once everyone tries to leave simultaneously, the gates close, the systems freeze, and the wealth you thought you had becomes a number on a screen that shrinks by the hour while you watch, helpless and unable to act. The choice is yours. The timeline is closing.